Okay, good evening, class. You're welcome to another of our classes. And tonight, we are going to be stepping forward. Tonight, we'll be looking at IFRS 16 on leases. So last week, what we looked at was IS 36 on impairment of non-current assets. And thankfully, we're able to start and finish that. And also during the week, and on Thursday, we're also able to start IFRS 15 on revenue. And I've informed you that we'll continue that on Thursday so as to finish it and also to start IAS 8 on accounting policies. So let's face what we have for tonight. Let's try and see if we can finish a significant part of this standard. I know I cannot finish everything tonight. At least let's see if we can get very far. So IFRS 16 on leases. This is a relatively new standard. And when it comes to a lease, some people can call it hire purchase. Some people can call it rent. And some other names you might want to give to it. But for us, in reporting, we call it lease. Whether you rent a building, whether you rent anything, or you have an asset under hire purchase, for reporting, we see everything as lease. And IFRS 16 actually deals with any form of transaction whereby you are using an asset that is not your own. And you're using that asset to make money. Whether to make money or not to make money, but you're using an asset that is not your own. IFRS 16 takes care of accounting for the money you pay for that asset itself, how do you account for it in your books? All of that is what we want to learn tonight. So the very first thing we are going to look at is what is a lease? What is a lease? And from here, this is saying that a lease is a contract or part of a contract that conveys the right to use an asset, which we call the underlying asset, for a period in exchange for consideration. So a lease is a contract, which means that before we can say that a transaction is a lease, there has to be a contract. A contract must exist. That's the first most important thing. And a lease will simply be part of a contract, which means you can have a contract and a lease is just part of it. That means that contract will be dealing with some other issues. But there is a lease there. And part of what you are going to learn in this class tonight is trying to even be able to identify that there is a lease there. That's a major skill that you need to learn tonight. So this contract, or part of a contract, it is a lease if the words of that contract, if the spirit of that contract is that it conveys the right to use an asset for a period in exchange for consideration, which means that that contract must state that someone has conveyed the right to use an asset. Conveying the right to use an asset means that somebody that owns an asset has transferred the right to use that asset to another person, which means that there is somebody that is not the owner of an asset and is the one using that asset. And it's usually for a period and is never free. You would pay for it in exchange for consideration. From this definition, you will see that there will be at least two parties in this contract, this lease contract, two parties. There is the owner of the assets, whom we call a lessor. He is the one that is conveying, transferring the right to use an asset. He is the owner of the asset. We call him the lessor. There's another party called the lessee, who is the person using the asset. Who is the tenant? That's the lessee. And by introduction, that is a lease. And you will then see that from this definition, it simply means that when you have an arrangement whereby a party is using an asset that is not his own for its economic activities, possibly that is a lease. So fundamentally, one of the key things we need to immediately sort out is how do you identify a lease in a contract? That's a major one for tonight. How do you identify a lease in a contract? That when you see a contract, how would you know that, this is a lease arrangement and we should apply IFRS 16 in this? And for you to identify a lease in a contract, there must be right of control, which means that the contract must contain right to control an identified asset. And the person that has this right to control must be the person who is not the owner of the asset, must be a tenant, must be a lessee. When a lessee has right to control an identified asset, there is a lease in that contract. And when we say right to control, it means two things. One, it represents the right to obtain substantially all the economic benefit from using the identified asset, and also right to direct the use of the asset. Right to obtain substantially all economic benefit and right to direct the use of the asset. These two must coexist, not one of them. The two of them must coexist for us to say there is right of control. And when we say right to obtain substantially all economic benefit, what we are simply saying there is that is the lessee that is the sole user of that asset. It is the lessee that is only benefiting from that asset, none other but him. That means if you have a scenario whereby a landlord is still sharing the space, sharing the asset with the lessee, that is not a lease. And fundamentally, what is it benefiting from? It has to be an identified asset, which means that if the arrangement is such that, let's say the lessee wants to rent a bus from the lessor, from the owner of that bus. And the owner of that bus now tells the lessee that, you see, I have 5 buses. since you want to rent one of them, so you are free to pick any one of them whenever you need it. Just come and pick any one of them. If the wordings of the contract is in that manner, that is not a lease. Because in that wise, we don't have a specified or identified asset. When they say come and use any one of my assets, for there to be a lease, there has to be an identified asset. There has to be that singular asset that we can say that this is the asset that has been, that you have the right to use, solely you. So for us to say that you have right to obtain substantially all economic benefits, it goes to show that you are the only one using that asset. None other but you. And I say you, I mean the lessee. Secondly, is that you have the right to direct the use of the asset, which goes to show that it's the lessee that will decide the function he wants to put the asset to, the activities he wants to carry out with the asset. He makes decision around that. That is right to control. If you see a contract like this, where they gave us a transport company called BDO, where he entered into a 3-year contract with CML, under which CML supplies BDO with 5 luxurious buses for the purposes of interstate transport. So the identified asset here is 5 luxurious buses. And the owner of this asset is CML. The lessee is BDO. We're not told that CML owns 5 buses specified in the contract. BDO determines the route taken for the interstate transport as well as the pricing. BDO can choose the buses for the purpose other than the interstate transport. When the buses are not being used, they are kept within the premises of BDO and cannot be retrieved by CML unless BDO defaults on payment. If the buses need to be serviced or repaired, CML is obliged to provide a temporary replacement of the same types of bus. Determine whether the above contract is a lease contract. Okay. The way you know that the contract is a lease contract, again, is by identifying right to control. And from here, what I'm seeing here is that BDO is the lessee, CML is the lessor. And I can see that BDO is the one determining the route. And BDO can choose to even use it for any other purpose other than the route, which goes to show that BDO is the one directing the use of the assets. Remember, he's not even the owner, he's the lessee. And from here, you can also see that it's only BDO that is using this asset, because there is nowhere here where we're told that CML is also still using it. Even to the point that when the buses are not being used, they are in the premises of BDO, and it cannot be retrieved by CML unless there's a default on payment. See, that shows that these assets are being solely used by BDO. But you need to understand something, that even if the buses are kept in the premises of CML, provided that CML is not using it or is agreed that it cannot be used, you cannot conclude that it's not a lease, even if it is kept in. So being kept in the premises of BDO, that makes it simple and clear. You can easily use that as a pointer to show that BDO is the only one using it. But that does not mean it cannot be kept in the premises of CML. It can. What is important is CML is not using it. That is only BDO that is using it. It's only BDO that is using it. So in this case, the two are present. BDO is the only one using the assets, which means that the economic benefit substantially goes to BDO, and also BDO has right to direct the use of these assets. So there's a list in this contract. And even this last paragraph is saying that it's only when they need to service this asset that CML can say he wants to replace the assets. Because for us to say there is a lease in a contract, replacement of the asset is not even allowed. Because I told you that there must be an identified asset. But when there is need for servicing and all of that, so BDO needs something to still function, to still work with. So that makes sense for there to be a temporary replacement at that point in time. Okay, so that's what I mean by right of control. Same thing here in this scenario too. This scenario now, you will see that it's not a lease contract, simply because, you see, BDO is the lessee, right? Just following up from the last question, CML is still the lessor. So the thing now is this. You see, they said BDO entered into a 2-year contract with CML for the use of one of its luxurious buses. One of its luxurious buses. So this one of its luxurious buses means that we don't have an identified asset, because we don't, it could be any one of them. That is not, we don't have an identified asset. So that goes to show that BDO cannot be the only one using this asset. And another one, they told us that the luxurious bus must seat 45 people, but CML can use any of the 45-seater luxurious buses when required. See, CML can still use the asset. That shows that this is not a lease at all. It doesn't meet it. This one, WASPA enters into a 10-year contract with Telecom for the right to use 3 specified physically dark fiber within a large fiber optic cable connecting Osun to Ibadan. Okay. So WASPA makes the decision about the use of this fiber by connecting each end of the fiber to its electronic equipment. WASPA powers the fibers and decides what data and how much data those fibers will transport. So this is a lease already, because WASPA is the lessee, the telecom company is the lessor. And you can see there is an identified asset, which is the dark fiber, right? And it is WASPA that is making decisions around how he wants to use that fiber and all of that. So that is a lease. When you are the one directing the use and you are the only one using the assets, that goes to show that you are the only one obtaining substantially all the economic benefits. And of course, you must also be the one making decision about the use of the assets, which WASPA is doing right there. So there is a lease here. This one says under a 4-year agreement, a car seat wholesaler called car seats buys its seats from a manufacturer. We're now told that under the terms of the agreement, we're told that car seats licenses its know-how to manufacture royalty free to allow you to construct a machine capable of manufacturing the car seat to car seat specifications. Ownership of the know-how remains with car seats, and the machine has an economic life of 4 years. Said car seat pays an amount per car seat produced by manufacturer. However, the agreement states that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost of his investment in the machinery. The agreement states that the machinery cannot be used to make seats for other customers of manufacturer, and that car seat can purchase the machinery at any time at a price equivalent to the minimum guaranteed payment not yet paid required. Is there a lease in this arrangement? Okay, this one is not so straightforward. So here, they said, under a 4-year agreement, a car seat wholesaler buys a seat from a manufacturer, and so this is a normal buying and selling. So a car seat wholesaler, car seat, buy its seats from a manufacturer, okay. And I said, under the terms of the agreement, car seat licenses know-how. Car seat, who is the buyer, okay, he now licenses know-how to manufacture royalty-free to allow you to construct a machine capable of manufacturing the car seat to car seat specification. Okay, as mentioned, so car seat gave a know-how to manufacture, like a knowledge, like a skill or something like that, to manufacture royalty-free, free of charge. So the manufacturer can manufacture a machine that would be able to produce that car seat in car seat specification in the way this guy wants it. So apparently the buyer wants the car seat to be designed in a way to be designed in a way that he really likes it. So he then gave the manufacturer a way to manufacture a machine so that he can be producing that car seat for him that way that he wants it. Okay. Now said ownership of the know-how remains with car seat, and the machine has an economic life of 4 years. Okay. So the way to manufacture that machine still belongs to car seats. However, the machine that was produced by that manufacturer says it has 4 years useful life. And now told that car seat pays an amount per car seat produced by manufacturer. Okay. That's maybe the purchase price. However, now said the agreement states that a minimum payment will be guaranteed each year to allow manufacturer to recover the cost of his investment in the machinery. So they are saying that in addition to the money that car seats pay for the car seat it buys from manufacturer, he must also add something extra so that the investment manufacturer has put in manufacturing that machine in a way that car seats likes it, manufacturing that machine so that you can produce those car seats in a way that car seats likes it. So they say car seat must pay something extra on top of the normal purchase price for those car seats. So they said that this agreement states that the machinery cannot be used to make seats for other customers of manufacturer, and that car seat can purchase the machinery at any time. So they are not saying that the machinery that was manufactured by manufacturer using his own money, even though we know that it was car seats that taught him how to produce that machine, but I mean, it was one that spent all his money. He owns the machine, manufacturer. But this machinery cannot be used to make seats for other customers of manufacturer. So it's only car seats. And we're told that car seat can decide to buy the machinery from manufacturer. So is there a lease here? Yeah, of course, there's a lease here from what I can see here. Because one, and the lease is around this machine that was produced by manufacturer. because Manufac is the owner of this machine. But this machine now happens to only benefit CASIT, because we're told here that the agreement states that the machinery cannot be used to make seat for other customers of Manufac except CASIT alone. So indirectly, as far as this machine is concerned, CASIT has right to control. Because from here now, it's only CASIT that is obtaining all the economic benefit from this asset. And also is the one even directing the use. He's the one dictating, he was the one that dictated how the asset will be produced, what they will use it for, and all of that. So there is a contract, there is a lease in this contract. Just that it's not only lease that is there. There is another component, which is the purchase, the normal purchase agreement, sales agreement to buy car seat from Manufac. That is also in the contract. But in addition to that, there is also a lease in this contract. There is also a lease in this contract. Okay, so that's that for identifying a lease in a contract. The next thing is lease term. So a lease term is usually a non-cancelable period. Okay, it's not a period we expect that you cancel. It's usually a non-cancelable period. And this non-cancelable period, it might be extended. It might be extended. So it can cover periods covered by an option to extend, meaning they can decide to extend. That is, if the lessee is reasonably certain to exercise the option to extend. So if it's certain, I mean, if they tell us that the lease time is 5 years, meaning that 5 years is non-cancelable. It's not something we can say we want to cancel down the line. But if in the same contract we were told that it's favorable for the lessee to extend by another 2 years, if they say it's favorable for the lessee to extend, that means it's certain that the lessee will extend. So in that wise now, the lease term is not just going to be that 5 years, the non-cancelable period anymore. It's going to be 5 plus 2, because we're told that the lessee is favorable for the lessee to extend by another 2 years. Also, it might even cover a period where there's an option to terminate. And that's if the lessee is reasonably certain not to exercise. Or if he's certain to exercise, then that shortens the lease term. It's just like the lease term is 5 years, and there's a place in the contract, though this one is unlikely, but let's say there's a place in the contract that states that the lessee can extend, that this contract can be terminated within 2 years. So we are saying that if it is certain that the lessee will terminate, that means the lease time is just 2 years, but is not something you find in your exams. So the one you find is when there's an option to extend, which is the first one. It's just like this. Like a lease contract is for 5 years. Lease payment is 10,000 naira per annum. We're now told that the lease contract contains a clause which allows the lessee to extend for another 3 years for a lease payment of 5 naira per annum. It is unlikely that the lessor will be able to lease the asset to another party. The economic life is expected to be 8 years. Okay. You will see that this one, the non-cancelable period or the lease term was originally 5 years. But now we're told that the lessee can extend. And in the period of extension, instead of paying 10,000 it was paying before, it will be paying 5 naira per annum. We'll be paying 5 naira per annum. So that's favorable to him. So he would definitely extend. He will definitely extend. So that means right from the inception, right from the beginning of the lease, we are going to treat the lease term as 8 years, 5 plus 3. Because it's certain that it will extend. That's what we're talking about. Now, when we have a lease, remember, there are two parties. There are two parties involved. There is the lessee and there is the lessor. Now, those two parties, how do we account for each of them? How do we account for each of them? So we need to look at lessee accounting as well as the lessor accounting. So let's start with how the lessee account for the lease arrangements. Let's start with how the lessee account for the lease arrangement. So now, at the commencement dates, as soon as the lessee starts using these assets, in fact, as soon as they have transferred the right to use the asset to him, that the asset is available for him to use, immediately the lessee will recognize a liability and a right to use that asset. Immediately, he will recognize a liability and a right to use assets. So liability credits, right to use debits. So it's just like we have a contract where you are paying 10,000 naira per annum for 5 years. That is usually the way leases looks like. And we are saying right from day one, you should recognize a liability and a right of use asset. So this right of use asset is synonymous to that asset in itself. So what we are saying is this. If you are recognizing a liability right from commencement, how much liability are you recognizing? Being a lessee, remember, is just the tenant. And if you are recognizing a right of use asset, what will be the valuation of that asset? That we're going to enter it in our books. And you see, when we talk about how much liability are we supposed to recognize, even without me telling you, you should know. If you have, I give you an example of you rent a building, or let's say an asset, whatever asset, and you're supposed to pay 10,000 naira per annum for 5 years. So if somebody asks you, as far as this asset that you have rented is concerned, how much do you owe? Let's even look at it on the surface. How much do you owe? You owe 50,000 as far as accounting is concerned, because a liability is a present obligation that you have no practical ability to avoid. Since you have collected the assets from the owner and you have signed a contract that you'll be paying 10,000 per annum for 5 years. So right from day one, you owe 50,000. That's what you owe. Just that in reporting, we don't recognize future value because that 50,000 is a future value. So what we actually recognize is the present value of those payments. Since the payment is going to be equal amounts, so we're going to use annuity to discount it to present value. We use annuity to discount it to present value. So it's very logical, extremely logical. So no hide and seek around it. That is your lease liability. And which is what I wrote here. Present value of lease payments not paid at the commencement date. That is how much. you would measure the liability. And you can guess that's how much the right of use assets would also be. Is the present value of those payments. But in real life, the way it will have happened is that before this guy would drop his asset for you, before the owner would drop his asset, for the most part, they will want you to drop a deposit. They will ask you to drop a deposit. So you always drop a deposit. So if you have dropped a deposit of, let's say you dropped a deposit of 10,000 and they are still saying that, okay, for the next 5 years, let's say the money you will now pay is now, let's say 9,000 because you dropped a deposit of 10K. You know that your liability is just the 9,000 for the next 5 years that you need to pay because that's your liability. But again, you need to discount that to present value. Do you know that your asset is now going to be that liability, the same amount you put as lease liability is also the same amount here. However, this right of use asset is now going to include the amount you paid at the commencement date, that 10,000 that you pay as deposit to be included as part of this right of use. Because the double entry for that deposit is you are crediting bank, you will come and debit this right of use. Really, it's really not more than that. The only thing is just that um, the rent that you are paying every year, usually it could be fixed, which is the scenario you would always find in your exams, the fixed one. But that does not mean that in real life, there won't be variations. It will vary after 2 or 3 years, the increments and all of that. So those increments, if they would exist, you need to factor them in discounting, because that means your liability is higher. You cannot just use that fixed payment. And also, if there's something we call guaranteed residual value guarantee, depending on the contract, the lessee might have guaranteed the lessor that the asset will be worth a specified amount at the end of the lease. I mean, this clause is always there just so that the lessee will not misuse these assets. So they will really want him to make some guarantees that at least at the end of him using these assets, the assets will still be worth so amount. In such a way that if the asset is not worth that amount anymore, that means we can conclude that the lessee has misused the asset and he will be required to pay up. So residual value guarantee is usually will have been factored in right from day one. And we'll consider it as part of his liability because he has to make it available either in asset value or in money. If the asset is not worth that anymore, you'll be required to drop money. And also, if the lessee have keyed into a purchase option whereby at the end of the lease term, he will be willing to buy the assets of the lessor. Again, in most cases, they will not wait until the end of the lease term before he pays. they will have factored it in the lease rentals that he will have been paying it. Then immediately at the end of the lease, they will just hand over the assets to the lessee. So purchase option would also be part of his liability as from day one. Since he has already expressed interest to buy the asset at the end of the lease term, that's purchase option. So I'm just mentioning all of this just to let you know that when it comes to determining lease liability, is something that is determined right from day one and is a function of the contracts depending on what they have agreed. So anything that would make the lessee pay additional sum in the future, that has to be considered in the liability today, like where there will be increments in rents, where there will be variations, or where he has guaranteed the residual value, or where there is a purchase option. All those will constitute part of the liability of the lessee. Additionally, at the end of the year, because all I'm still talking about is at the commencement dates, when he's recognizing that liability. You see, at the end of the year, that liability would be increased by interest. Remember that we discounted that liability. We did a present value. And anytime we present value an amount in reporting, at the end of the year, we need to unwind the discount. And we usually do that through interest. So that lease liability at the end of the year will be increased by interest. And you know that at the end of the year, it's possible that the lessee will start paying up. So we're going to use that to reduce the liability, whatever he pays. You see, this sequencing of adjusting the liability is very important. You have to sequence it in this order in such a way that you have to add the interest first before you reduce the lease payments. If you don't do that, it means something else entirely and you will not get the same result. You'll see what I'm talking about very soon when I solve a question. And this is also on the assumption that this lease payment is made at the end of the year. That's where this sequencing can work, where you add interest before you reduce lease rental. Because both of them are happening at the end of the year. Both the unwinding of discount, that's the interest, and also the rent. They are happening at the end of the year. But you need to add interest first before you reduce the lease rental. But you know that it's also possible for these rents to be paid at the beginning of every year. It's possible. If this rent is paid at the beginning of every year, this sequencing will change. The sequencing will change, which means that it will be the rent that we're going to deduct before we come and add the interest. If the rent is paid at the beginning, so it's logical for us to remove it first because interest is always at the end of the year before we then add the interest. So that's basically how we account for the lease liability. At the beginning of the year, we just take the present value of the cash flows of the rent. At the end of the year, if the rent is paid in arrears, that is at the end of each year, we would increase the interest. We increase the liability with interest and also reduce the liability with rent. That's the sequence. But if the rent is paid at the beginning of every year, we will need to reduce the rent first before you add the interest. And that's all for that. The other leg of this liability is right of use assets. That's a term used in IFRS 16 to describe that asset that you have rented. Right of use asset. That's what we call it. And like I told you, this asset is measured at cost, and the cost is the amount at which you measure the liability. I told you the PV of the lease rental not paid, the same way you have measured the liability. Okay, the PV of lease of unpaid lease rentals, and if there is any payment at the commencement date, which is that deposit I told you about, that would also be added. And you can less any lease incentives. So at the commencement date, it's possible that the lessor has given you some sort of incentive, some sort of reduction in price that you're expected to deduct from the payment at the commencement date. And if there is any directly attributable cost, it should be added. And also, if there is any estimate of dismantling and restoration cost, that should also be added. So that's how you measure the right of use asset at the beginning of the year. And at the end of the year, you would carry the right of use assets at carrying amount, meaning you depreciate it just like you depreciate any other PPE by doing costs minus accumulated depreciation minus accumulated impairment losses. But when it comes to right of use assets, you're expected to depreciate it over the lease term. Over the lease term. Some people will say over the lower of the lease term and the useful life. But why would the useful life be lower than the lease term? Why would anybody agree to a lease term that is lower than the useful life of the asset, except if he doesn't know? So for them to give us the two available, that means you know what the useful life is. So there's no practical reason why you would agree to a lease term that is lower than the useful life. So usually what you will find is that the lease term will be lower. So we expect to depreciate the assets over its lease term. If you lease an investment property, usually most investment property are measured at fair value, so we don't depreciate those ones. So the right of use asset to be measured at fair value. And if that asset you lease, you're measuring it at revaluation model, that means you apply those principles you learned under year 16, which means that we might have to revalue the assets if necessary, but still is optional anyway. So majorly for exams on lease, you just need to depreciate the assets over the lease term. So let's look at this question. It says that on 4th January 2002, Networth Limited bought a plant from Password Limited under a lease contract. The terms of the lease requires Networth to make 4 annual installments of 2 million each, payable at 31st December. The present value of the lease payment is 5.7 million. The interest rate implicit in the lease is 15% per annum, and it is estimated that the plant will be economically productive for 5 years. There's an opportunity to extend the lease term at conditions favorable to Networth. The reporting date of Networth is 31st December required. Show the financial statement extract of Networth over the relevant period. Okay, so this is the typical question that I'm talking about. So January 2002, Network bought a plant from Password under a lease contract. The terms of the lease requires Network to make 4 annual installments of 2 million per annum. So that means 4 years is the lease term, and it's payable at the end of each year. So that means this rent of 2 million is payable in arrears. So these guys already gave us the PV of the lease payments. So you don't have to do the discounting yourself. They've already made it easy for you. We're now told that the interest rate implicit in the lease is 15% per annum, and it is estimated that the plant will be economically productive for 5 years. So that's the useful life of the plant. So there's an opportunity to extend the lease at conditions favorable to Network. So since they told us that Network can extend and is favorable to him, so that means the lease time is not 4 years anymore. That means he will extend to up to his useful life. You cannot extend beyond his useful life. So that means the lease time should be 5 years, which is the useful life. So which means when we are depreciating the right of use assets, it will be depreciated over the lease term, which is 5 years. So we are asked to show the financial statement extract. So again, like I told you earlier, for the lessee, at commencement dates, what it does immediately is to debit right of use asset and credit lease liability. That is what it does at the commencement date. And let's get the value of the lease liability. At commencement date, I already told you that it's measured at the present value of the lease rentals. It's measured at the present value of the lease rentals, which they gave you in the question. Most questions would give you. If they don't, that means you use annuity factor. The one plus the bracket 1 minus 1 minus the bracket 1 plus r raised power minus n over r. But in most of questions in lease, you find out that they will just give it to you. They will give you the PV already. So they gave us here, which is at the commencement, which I have here as balance brought forward in 2002. At the end of the year, we are going to increase this 5.7 million with interest. And the discount rate given to us here is 15%. So we simply do 15% of 5.7 million. That comes to 855,000. So if we add these two together, it gives 6,555,000. Then he makes his lease payment of 2 million. That brings it down to 4,555,000. He will carry forward this to the next year, the 4,555,000. You do the same thing over again. You add the interest of 15% of the 4.5 million. That gives us 683,250. If you add that to the 4.5, it gives us 5.2 million. Then we pay the rent of 2 million. By the time you remove the rent of 2 million, it brings it down to 3.2 million. The liability, which we are going to carry forward again to next year, 3.2 million. You do the same thing over again. You add the interest, 15% of 3.2 gives you 485,738. You add it to the 3.2, we get 3.723. You deduct the rent of 2 million. We have 1.7 million, which are going to carry forward again in year 4. Again, you do the same thing. You add the interest of 15% of 1.7. It gives you 258,598. You add it together, you get 1.9. You pay your rent. Then ordinarily, at the end of the fourth annual installment payment, this should become zero, but I think it's approximation error since they give you the PV themselves and all of that. So this should have been zero, but doesn't matter anyways. So I'm done with this schedule. That's the lease liability for the 4 years. For the right of use assets, again, is initially measured at the PV of the unpaid lease rental. The same way you initially measure your liability is how you're going to initially measure your right of use assets. Then you add any amount paid at the commencement dates. In this case, there was no amount paid at the commencement dates. If there is any directly attributable costs, that would also be added. If there is any decommissioning costs, that would also be added. In this case, we don't have any of such. So our total cost remains 5.7 million. So this right of use asset will be depreciated over the lease term, which is 5 years. And it's 5 years because we're told that the lessee can extend under favorable conditions. So that means every year, our depreciation per annum is the cost, the right of use asset cost, divided by the lease term. Then that gives us 1,140,000 as the depreciation every year. And that will be our depreciation every year. Okay. So since the question requested that we do financial statement extracts, so let's prepare our statement of profit or loss. And from the lease liability schedule we did, the only item that will go to P&L is these interests, this finance cost. Those are the items that will go to P&L every year. So in year one, which is 2002, 855 will go to P&L. In year two, 683. In year three, 485. In year four, 258, like that. And also, this depreciation would also go to P&L. So, and that's why those are the only two items you find there in our statement of profit or loss extract. Also, in the statement of financial position, under your non-current assets, you have your right of use assets. Knowing fully well that the cost we computed for the right of use asset was 5.7 million. So you will see that the cost in year one, year two, year three, year four, year five, all through the life remains the cost. While the accumulated depreciation, in year one now, that's the year one depreciation. In year two is the cumulative. In year three is cumulative of year one, year two, year three. In year four, cumulative of year one, year two, year three, year four. In year five, you see everything nets out. That's how accumulated depreciation works. On the liability side, you will see that I splitted this liability into current and non-current. Why did I split it into current and non-current? The reason is because in leases, when you have lease transaction, you are expected to do that. It's compulsory that you split, because we can easily tell with this schedule that we did for the lease liability, we can easily tell how much is due next year and how much is due after more than 1 year. So it's relatively easy for us to split this liability into current and non-current. And in 2002, you would agree with me that our liability at the end of 2002 is this 4.5 million, the balance carried forward. That's the liability in 2002, the 4.555 million. Now, ordinarily, one would be tempted to think that this liability should be recognized as part of non-current liability. But you'll be wrong, because a portion of this liability will be settled next year. A portion will be settled because we're going to pay another 2 million next year. So this 4.5 million needs to be splitted between current and non-current. So the current portion are the ones that is due to be paid next year, while the non-current is the balance. And the easiest way for you to do that split in the exam so that you will not make mistakes, because you will have done this schedule, right? So by the time we get the liability in the current year, and we can see what our liability is in the next year, which is the balance carried forward in the next year. In this case, is 3.2 million, which goes to show that our liability has now reduced from 4.5 in year 1 to 3.2 in year 2. You can guess that the reason why it reduced is because the reduction is what we would have settled. So we can say that the difference between these two is our current liability, is what we will pay next year. That's the current liability, what we will pay next year. The difference. So by the time you take away the difference from this our liability this year, it's going to give you this 3.2. Okay. So in year 1 now, we can say this 3.2 is the non-current. This 3.2 is the non-current, which is the balance of year 2. So the way you split this liability of year 1 is looking at the balance of the second year, because the balance of the second year would show what you'll be owing at the end of the second year, which will be paid much later. So already you can easily identify that that is the non-current portion of this 4.5, and the reduction will represent the one you will pay immediately next year, which is the current portion. If I want to do the same analysis for 2003, let's say we're in 2003. In 2003 now, our liability is 3.238. Again, this one, there is a portion we are paying next year, and there is a portion we are paying after more than 1 year. So when you look at the balance of the liability next year, which is the 1.7, you will see that it has reduced. It reduced from 3.2 to 1.7. That reduction is the current, because that means that is the one we will settle next year. The balance of 1.7 is the non-current portion. And that's why you're going to split this 3.2. And you can continue on and on like that. But in year 3, which is 2004, this liability of 1.4 million is due to be settled only next year, because next year is the end of the lease, is the final payment period where we will have settled all the liability. So that means this 1.7 is totally current. And that's the analysis I did in this liability part, where I separated in 2002. I separated the liability into current and non-current. So the current is 1.3. The non-current is 3.2. The same thing in year 2. The same thing in year 3. Okay. So that is it for this question. I'm assuming is very straightforward and well understood.
Yeah.
Yes, please.
So how was the current liability split to this liability and to current liability and non-current liability?
How was the current? I didn't get your question. Sorry.
How was the lease liability split to current and non-current liability?
Okay. That was what I finished explaining just now. Although I just finished explaining to you that in year two, the liability, in year one, the liability was 4.5 million. That since we know from this schedule, in every lease liability, we know how much you will pay next year because we pay every year. And I said the easiest way for you to do it in the exam so that you won't make mistakes is from this 4.5, the way you split it is for you to look at how much you will be owing next year. So the difference between these two already, between the 4.5 and 3.2, that means is the amount you will have settled. So we can say that that's the current liability portion of this 4.5, which is this 1.3 that you are seeing here under current liability. The balance is the 3.2, which means is the one that will be settled much more later in the future. And that is the non-current portion. That was what I explained. So it's still the same thing I'm still saying, but is that clear to you now?
Yes, sir. Thank you.
Okay. And the same thing applies in the second year also. In the second year, this liability of 3.2 million, this liability of 3.2 million, it has to be splitted between current and non-current because we know what you're paying next year. And when you look at next year, you see the liability has reduced to 1.7. The difference between these two is this is the one we describe as current. This 1.5 under current in year two. This 1.5. Because in this schedule, that's what you will pay next year. For your liability to have reduced from 3.2 to 1.7. That reduction is deemed to be what you settled, 1.5. And then whatever is the balance between that 1.5 and this 3.2, it will definitely be this 1.7. But let's just take it like that. Whatever is the balance, that's the non-current. Okay. And in year three, since in year three, we are going to settle whatever balance in next year. So that means the entire 1.7 will be under current because it's due next year, which is why this 1.7 year in year three is coming under current. Okay. Let's solve this second question on the list. It says that a company enters into a 4-year lease commencing on 1st January 2001 and intends to use the asset for 4 years. The terms are for payment of 50,000 commencing on 1st January 2001 and annually thereafter. The interest rate implicit in the lease is 7.5%, and the present value of lease payment not paid at 1st January 2001, that is 3 payments of 50,000, discounted at that rate is 130,026. Legal costs to set up the lease incurred by the company were 402 required. Show the lease liability from 1st January 2001 to 31st December 2004 and explain the treatment of the right of use assets like that. Okay, so almost similar question. So a company enters into a 4-year lease commencing on 1st January 2001. So he intends to use the asset for 4 years. So the terms is 4 payments of 50,000 commencing on 1st January and annually thereafter. Okay. So this one is showing that the lease rental will be paid in advance. The lease rental will be paid at the beginning of every year. So this is different from the last question we solved, where the lease rental was paid in arrears, that is at the end of every year. So it's quite different. So here now, the interest rate implicit in the lease is 7.5. And like I told you, they always give you the PV of the lease rentals. So the present value of the unpaid lease payments in 2001, that is 3 payments of 50,000. So why are they giving us only the present value of 3 payments? But they told us that we are making 4 payments. Why are they giving us present value of only 3 payments? The reason is that since we are making the payments right from the beginning of the year, so we'll have paid the first 50,000. Okay, out of the 4 payments, we'll have already made payment of the first 50,000, which goes to show that the remaining payment are just the 3 payments. Those are the ones you will need to discount to present value, because those are now the future payments that needs to be discounted. And that's why they only give us the present value of the 3 payments. So these were discounted at the rate of, using the discount rate. So the present value is 130.06. We're given the legal cost to set up the lease, and that legal cost is 402. So we're now asked to determine the lease liability and also determine the treatment of the right of use asset. So again, the lease liability, the same principle. At the beginning, they already gave us the PV of the lease rentals as 130.026. And since the lease payment are paid at the commencement date, so the lease payment is going to come first. Okay, this is where I was talking about the sequencing. That if the lease rentals is paid at the commencement date, you need to remove the lease rental first before you add the interest. So the lease rentals needs to be removed first. But in this case, since the lease rental has already been paid, so that's why this one is 0. It's not owed anymore. It has been paid. It's not even included in this 130. This 130 was the present value of just 3 payments. So that's why this is 0, because it has been paid at the commencement date already. So then we add the interest, which is 7.5% of 130,026. That gives 9,752. You will then add that to the 130. That gives us 139,778, which we are going to carry forward to the next year. So when we carry that forward to the next year, you will then deduct your lease payment of 50,000. So when you deduct your lease payment of 50,000, we would have 89,778. So when we have 89,778, we will then add our interest of 6,733, which is 7.5% of 89,778. So that gives us our interest. So the interest will be added to the 89,778. So we'll have our liability of 96,511, which will be carried forward to the next year. Again, since the lease rental is paid at the commencement date, you deduct. That brings your balance to 46,511. Then you apply your interest at 7.5%. That will give you 3,488. When you add that together, it comes to 50,000. So which you're going to carry forward next year. And that you deduct your rent payment, so it becomes 0. So this schedule is the only difference between this and what we did last is the fact that since the lease rental is paid at the commencement date, you need to deduct the lease rental before you add the interest. That's the major difference here. Then the right of use assets. The right of use assets is initially measured at the present value of the unpaid lease rental at the commencement date, which in the question were given as 130.026. Then you are going to add the amount paid at the commencement date, and the amount paid at the commencement date is 50,000. Remember, we are paying at the beginning of every year. So what was paid right from commencement will be added. Then there was a legal cost given in the question, which is a directly attributable cost of 402. So by the time you add these three items together, we'll get the total cost of that asset. And these right of use assets would be depreciated over the lease term, which is 180,428 divided by 5. And that gives us depreciation per annum of 45,107. And that settles this question. Now, you see, this for lessee, the whole idea is that he has rented a property, and IFRS 16 requires that he recognizes a lease liability and a right of use assets this way. It won't be more than this in the exam. It's really not more than this. But this standard allows something we call exemption, optional exemption. That is it every time you must recognize the liability and the right of use asset. The standard says no. That there are two situations where you might not have to do this. Number one is if you have a short-term lease, that is a lease of 12 months or lower, that there's no point doing lease liability since it's just a short-term lease. And number two, if the underlying asset is of low value. In the exam, they will tell you that it is of low value. So nobody would stress you on determining the definition of low value. You'll be informed. So, and again, it's optional. It's optional. So you might still go ahead and do your normal lease liability and right of use asset. But I mean, we have been given a leeway out that when you have a short term, it's just like renting an apartment for your office for 1 year and you're paying 2 million per annum. Just put your rent in P&L. But if you want to go by what I've just taught you, that rent is not going to show in P&L at all because you would recognize it right from the commencement date at as a lease liability in such a way that when you're not paying it at the due date, you'll probably be crediting bank and debiting this liability. So it's not going to show at all in your P&L. And if you are paying it at commencement dates, it's like you're crediting bank and you ultimately debit right of use asset. So, which is what you find. And when you see right of use assets in any balance sheet, you should know that what they are talking about is um they are talking about lease arrangements. Lease arrangement. Okay. I guess I should stop here tonight. Have you are you guys done with group account? Is Mr.
Yes, so
Abid?
I'm
Yeah.
I'm group cash flow.
Okay. So you haven't done income tax?
Not yet, sir.
No.
Okay. So I'm looking at because there is one part of IFRS 2 that I left that time. I know all of you have forgotten.
Remember?
Relating to deferred tax, Abi? Do you remember?
Yes, sir.
Okay. So I was waiting for
Yes,
him
sir.
to teach you deferred tax on so that I can teach you that deferred tax implication of share-based payments. And I wanted to take it next week now. I don't know how I'm going to do it now. Okay, maybe next week we'll just finish lesson. I'll finish up lesson, then probably teach you IFRS 8 operating segments. I think that's what we should just do. Finish up lesson, do IFRS 8 operating segments. Then hopefully when it takes you that's deferred tax. Then I can then quickly discuss deferred tax implication of that. So I hope you guys are studying for this exam. The exam is now very close. Unfortunately, a lot of you are not joining. Maybe because you think you have the recordings, but you find out that that's a very good strategy later, because you will not be able to watch those videos. Those videos are not something that are easy to watch, because I use a lot of video lectures myself to learn a lot. If I really want to learn, if I want to study, a 1 hour video can take me a whole day. Because when you're watching a video like what I just taught you, you want to sit down and watch the video. You cannot be watching it and not pause to play again or to confirm some things that I'm saying, to sync it. Unless you are watching it like a movie, that's when. So those that are not joining, probably we need to reach out to them. ICAN is very demanding, and the timing of our class in the evening is very stressful for everybody. But I mean, it's what it's not when the exam is close. People are nowhere to be found. That's a very wrong strategy. That's giving up. We have to find a way to help them. So in the meantime, let me just stop here for today. Then on Thursday, we're going to round up IFRS 15 and hopefully get to a reasonable length in our years 8 on accounting policies.